Hey everybody, welcome back. So I also wanted to speak on the 203k loan because a lot of people are unfamiliar with what the 203k loan is and why I've been looking at that option. So a 203k loan is an FHA loan. Now, a lot of people don't understand what options that are available to them. So there's a lot of options available to you as a home buyer, especially a first-time home buyer. You have the FHA loan, which typically comes with permanent PMI but a lower interest rate. That is going to be more expensive than the conventional mortgage unless you are paying a whole lot more on top of that FHA loan. Typically, someone will not have a whole lot more to pay on top of the FHA loan because they are putting as little down as possible. Otherwise, if their credit was good and they had more money to put down, they would have went conventional, where their PMI drops off over a certain amount of time. And I would always advise someone to put 10 to 8% down rather than 20% down, because if you use any mortgage calculator, you would see that if you put 20% down without private mortgage insurance, you are going to pay a higher interest rate than if you had put 10 or 8% down. Your interest rate would actually be lower because you're paying private mortgage insurance. And then if you go conventional and then you add that 10% later, you get rid of the private mortgage insurance, but you also now have the better interest rate. So now your mortgage will go down. You will have that 20% that you wanted, but you will also have a lower interest rate because you had your initial mortgage at 10% rather than 20. So that is the pros and cons of conventional versus FHA, and I would always say to go conventional rather than FHA. Now, for those of you who don't know, I'm also a veteran. So an option for me is the VA loan. VA loan typically has closing costs associated with it unless you are 100% disabled, and you also have a fee associated with the VA loan, which typically I would still say is better than FHA. However, it is the most expensive loan in terms of the most interest you will pay over the life of a loan. Now, as an investor, you may see this as an opportunity. Although it's supposed to be used for your primary residence, you may see this as an opportunity to put 0% down and have a cash flowing property that is paying you without you putting any of your cash reserves into it. In this economy, it's hard to find anything that's going to cash flow at 0%. See, all of my properties were cash flowing a lot, but I had put 10% in them with lower interest rates. So now you have to do a lot more due diligence when looking for a property at 0% that's going to cash flow that no one has already snatched up yet at 20%, right? Because most investors are going to put 20% down. How are you going to find a gem of a property at 0% when you know that it would cash flow $700 a month if they had put 20% down? It's very, very difficult to find something at 0% that's going to cash flow and that nobody has already swooped up and grabbed. All right? So that is one of the concerns with the VA loan and putting no money down, is that if there is a product out there that you can buy for that, an investor is probably going to put more money down and cash flow more than you would, and they would hop on that a lot quicker in the same time span. So what I always do is I continue to monitor the markets. I continue to look for deals. I continue to look for homes that have been on the market for a longer period of time. I continue to look for things that investors may not be looking for. And honestly, you might have to go door to door in order to find a deal of that magnitude, because honestly, if it goes online, people are going to swipe that up before you can put your 0% down offer on that home. It's just an inevitability. There are jobs out here in my area where you are literally paid to cold call 100 people and ask them if they want to sell their home. I can't tell you how many times people have wanted to buy either one of my properties, right? So that are not for sale. So I can tell you right now that if you're looking for a 0% down option that is going to cash flow $500 to $700, there are investors out there who are ready to put more money down and cash flow even greater profits. And so you are literally going to be waiting years in order to find a deal like that. Now, with that out of the way, we understand that the VA option is probably not a viable option, because I'd rather go conventional with a better rate than pay the same amount of money and go VA with higher fees. Now, what is the FHA 203K loan? I've already told you that conventional is better than any FHA mortgage, but the FHA 203K loan provides you the opportunity to rehab a property that is not ready to move into. So, for example, there was a fourplex that I wanted, and I can offset some of the expenses by moving people in door by door and saying that the rental income is basically $1,200 per unit. Now, for example, there are a few properties in Ohio that, let's say it's a triplex. 2 of the units are ready to go, but 1 unit needs to be rehabbed. I have a property like that right now. I see a property like that I'm willing to invest in, right? And the rents on 2 of the doors is $700 and the other one is $750. Now, to me, I could buy a single family property and do the same thing, because I am doing the same thing. Right now, I'm getting $715 and $700 per room. So why buy a triplex with 2 bedrooms, 1 bath each that is only being rented for $750 each? Location, location, location. If you have a good location, you can still get triplex money in a single family unit. So this is where a lot of due diligence is necessary in order to justify everything that you get into. So at $275,000, this triplex is being offered. It has gone off market twice and now is back on market. The 3rd unit has been gutted. Electrical has been started. Windows have been started. Insulation has been started. All of those things are the cheaper processes. What didn't I hear in that start is that plumbing hasn't been started. Plumbing is probably going to be your most expensive bill in doing a rehab, but it is also one of the easier things to get completed, because I know a whole bunch of plumbers in the Ohio market. However, at $275,000, I know that the cash flow on this unit is only $200 a month, and I'm going to have to rehab the unit. So if I'm looking at putting $25,000 into the property, I'm all in at $300,000. I am not cash flowing on this property at all, right? So what is needed here is either to buy it and not have it cash flow and try to break even by raising rents to $800 each, or wait for rates to drop down and refinance now within a better appraised value because I just rehabbed the home, or I have to get a discount on the home, still raise rents to $800, wait for rates to go down, and now I'm cash flowing an even greater amount, upwards of $800 a month to even $1,000 a month, which is the ideal situation. So let's say this home goes down to an evaluation of $240,000. That is a prime deal for me. At $240,000, I can see myself putting maybe $30,000 into the home. And now I'm all in at $270,000. Rather than purchasing the home now at $275,000, I have purchased the home and done the rehab at $270,000, which is $5,000 less than what is initially being offered at currently. Rates will go down eventually, which will also lower my monthly payment, and then rents will go up eventually, which will also increase my cash flow. That is the ideal situation for this property, to buy it at $240,000. So in my notes, I have listed, I want the mortgage payment to be $1,700 to $1,900 a month, because I know that's instant cash flow, and I'm not really worried about the equity in the home. I'm not one of those people at the moment who is worried about equity rather than cash flow. I'd rather cash flow than equity. And we can go over that in a later video. So now you can see why the 203K loan is a valuable option, because one, you can refinance a property because you are putting value into the property by doing the rehab on the property. Everything is managed by the construction team that is paid in drawers by your mortgage lender, and you are closing on the home and paying on something early. Therefore, you must have the capability of paying for the entirety of the home yourself prior to the rehab being concluded. Now, the VA does offer some rehab loans. However, it's only to help those who may have a disability and have railing installed, or railing in the showers, railing in the homes, and driveways in order to better accommodate yourself. Things like that that will ensure that someone is able to live a decent life and not be bedridden in their own homes, right? So if your stairs are given out, things like that, but not for major improvements like plumbing and everything else that is included in rehabbing a home. So you can see why the 203K loan is the most valuable option. So I spoke to a mortgage lender the other day and I qualified. Why? Because I went conventional every single time. If I had gone FHA, I would not be able to qualify for this loan right away. And so when people say go FHA, they don't realize how much opportunity they may be missing out on because they are trying to do a cheaper option initially. So with me doing a 203K loan, I'm basically not going to take out any other FHA type mortgage. But I do believe that the 203K loan is the best FHA loan that you could possibly use. With that being said, you are probably going to be quote unquote forced to live in that home for a year, just like any other FHA required loan. And then if I ever do decide to use the VA loan, that would be used separately without the FHA loan being utilized again. Now, with the FHA 203K loan, they expect you to refinance out of it, and that's why the rates are higher. So, for example, if rates are 6.3%, you can expect a 7.5% interest rate. And you can expect higher closing costs as well. Because of that, I was a little deterred. I wasn't deterred by the closing costs. I wasn't deterred by the lower payment, but I was deterred by the interest rate, because at 7.5% and housing prices dropping, even if I did do a rehab, I'm not expecting to get 20% equity in the home when I refinance out of it. I'd be lucky to get 10% and refinance into a conventional mortgage. So, with that being said, there's more due diligence that is needed now and more equity that is needed up front in order for me justifying doing a rehab on a property, so that I have enough equity to get out of the FHA mortgage in its entirety and go conventional. The good thing about going conventional off of a refinance is that you're even going to get better rates than had you gone conventional just buying the property outright. Because you already have the home and you're refinancing into a newer mortgage, you're going to get an even better rate than had you had just got the conventional mortgage up front. Because of this, I can see a space in where I have even better rate and even better cash flow. But with rates still going up, you don't know if after your rehab is done, rates won't be at 6.3%, and they may very well be at 7%. And then at that point, there's no reason to refinance out of the 203K loan for the FHA mortgage until rates go back down to a respectable level. So there's a lot of things happening now that you can't truly account for in this environment where the Fed is literally working against investors in this capacity. But back when rates were 2, 3, 4%, you can better account for these things and do what you needed to do. So again, you got to continue to do your due diligence, continue to understand what mortgages, what loans are best for you, that are best to service you. And then if you can, it'll be best to wait for prices to continue to drop. And once rates start to drop, that will be the prime opportunity for you to buy. So I just wanted to give you some information on the 203K loan. Why I'm able to still use it now is because I went conventional with both of my mortgages, and why that option is still available to me is because I have not written off everything in my taxes and continue to have a W-2 job that will pay me what I need in order to purchase the homes in the price range that I'm looking for. So I hope that all of those options, all of those loan options were good to you. And before I forget, there's another option available to you. It's called the Dream Makers loan. Now, this is a loan that I saw with Chase Bank that is available to those who make less than the average income in their communities. The Dream Makers loan is only available in certain areas, certain zip codes all over the 50 states. So whether you're in New York, California, or Ohio, there are options for you to have lower closing costs, which will allow you to get into a home a lot easier than had you gone into a different zip code or different area. This is very reminiscent of the zero down loans that you're now seeing Bank of America roll out in certain areas like New York and Florida. These high mortgage, high home housing areas. And they're doing it in low income communities where people typically do not want to move into. So essentially you have someone putting zero money down in an area with high crime and low demand. You're essentially asking them to buy a home that is going to depreciate in value and continue to have high crime. These people have no money to put into these communities. That's why they're putting zero down. Therefore, they have no ability to uplift their communities. Whereas in my community, you see the lawn is well taken care of. You see upgrades being done every day. Today I walked out of my home. My neighbor is doing construction on their home. You understand? The property is continuing to rise in value. They see I did my backyard. They're asking for my landscaper so that they can upgrade their backyards. These are the things that happen when people have money to invest in their communities. So when you put zero money down in a community that is not appreciating in value with high crime, and you're giving these loans to people who can't afford it because they don't make at least the average income for their communities, they're going to be underwater. They're more likely to default on their mortgages, and these homes are more likely to go to auction. They have no idea on taxes, property taxes, home repairs, and all the costs associated with home ownership that they don't have to deal with when renting. And therefore, when that water bill hits, when that electricity bill hits, when all those utilities hit, they're very much not prepared for that, especially in New York, where most utilities are included in your rent. So with that being said, they're in for a whirlwind of payments that they cannot afford or cannot plan for, especially when they're used to a cable bill, a Netflix bill, a car payment, and et cetera, et cetera, et cetera. So you can see how this can be taxing on those communities and how it's not going to be beneficial to those who don't have a high emergency fund, already have a lot of cash savings, and already were able to buy this home with money down rather than $0 down. This benefit is not truly a benefit to the uneducated, and it will cripple those who do not understand real estate or their own finances. So the zero money down option is really not an option. And this VA loan, right, when you're working at the military and you're putting $0 down, you have a consistent job, you're going to be there long term, you're not necessarily worried about renting it out or selling it, you're just making the payment for yourself. Therefore, a $0 down option that is tied to your job is typically going to do wonders for you, right? So you got to also understand those situations and those environments that you're in, and you're typically not buying in an area where you cannot sell the home. Another Army veteran or Navy veteran is going to come along and want to buy that same home from you and do this exactly what you did for the same reasons, right? So the zero down option is not something that everyone has or can obtain, and therefore not everybody is going to move in for the same reasons or the same options. Does the property have value? Yes, but as much value as to put $0 down and have instant equity? No. And so that's another thing to look at when looking into the market today. Now, in times of stress where people are getting laid off of their jobs, putting $0 down into a home and then losing your job, again, is going to be severely crippling. I would not advise people to take out a $0 down mortgage at this time, especially if you've never owned a home before in your life. With that being said, I hope that this video was very, very informative. I hope that you do more research on the mortgages that I've talked about today. If you have more questions, comments, or concerns, or want me to speak about a specific mortgage more in depth, please leave a comment down below and I'll be sure to get back to you. Thank you and have a great day.